Welcome back to Smart Money on CNBC TV 18. We've been talking about all the various insurance schemes in the market and what you need to pick, what you need to avoid, and how to plan your investment journey. Nasir Salim, Managing Partner at Flexi Capital, and Nehal Mota, co-founder of Finovate, are with us. Before the break, we were talking about the Married Women Property Act and how it could be beneficial for you. Nehal, you were telling us about some of the advantages of the Married Women Property Act and who it is suitable for. Tell us a little more about that.
So, if I am a person who has a lot of loans, liabilities, like Nasir said initially, for me, I don't want my insurance proceeds to get attached to pay off my liabilities. So, Married Women's Property Act is good, where I take a policy on my name. I make my wife the trustee and my wife and children the beneficiaries. In any untoward event, the money only belongs to them. It will not be attached by any creditors or any liability or any kind of risk which may be there because of my decisions.
Okay.
So that is one thing. And in certain situations, like there are parents who have specially abled children and they cannot make decisions with their money. And parents are looking at a private trust, which is like forming a trust. The paperwork and all can get very expensive. They want a very simple solution that they just put in the money. They attach an MWPA trust to it. The father takes a policy on his life. He pays the premium for 10-15 years. And after that, the child gets the money in the next 25-30 years.
Okay.
And through an MWPA trust, so the beneficiary is only the child. It can't go to anyone else. So for parents of a differently abled child, this is actually a very good solution to pass on the wealth and be assured that it will only go to the child and no one else.
Okay. So Nasir, just to wrap this up, right, the Married Women's Property Act, is it, do you have to take an insurance policy under this act? I mean, what is the procedure in order to secure yourself under this act?
So it's very simple. You see, it's basically nothing but, there is no dedicated insurance policy. Sonia, what it does is, it's basically creation of a trust. You buy an insurance policy and then you name that into that trust, basically, and therefore it becomes under the MWP Act. So it's a very simple format. You basically create a trust, which is a simple documentation. Once the MWP is created, you ensure that the insurance policy, for example, that we're talking about today, you buy a plan, which would be a combination of, unit link plus savings, which would be an endowment plan, for example, from one of the most reputed insurance providers. You engage with your advisor, speak to him, and then he will basically buy that plan for you. And that plan then gets written in, which is basically, as an application goes into it, which gets covered in the MWP Act as its policy holder.
Fair enough.
It's as simple. The moment that happens, it gets covered under the MWP Act.
Okay. Let's move on now and talk about the employer and employee plans, right? And what the merits of it are. Now, I am asking you this question because a lot of us have corporate jobs, and with corporate jobs comes corporate insurance. But because we have that safety net of corporate insurance, many people don't take insurance separately. Then what happens in case you either lose your job or you take early retirement? Suddenly you're left with no insurance. What do you do at a time like this?
So the employer-employee could be a life insurance or it could be a health insurance. So if you're referring to an employer-employee where it's a health insurance from the company, then in that case, you should always opt for super top-up personal health insurance as well. In certain situations where you're, switching between the jobs, or like you said, the pandemic left a lot of people out of job, right? So you can opt for a super top-up plan with a deductible where whatever your company provides as the base sum assured, that is deductible. And over and above that, if there is an additional medical expense, then the super top-up plan kicks in and you're still covered at all points of time.
Even if you don't have the job?
In this case, a base policy, which is very small, plus a super top-up is handy.
Okay. And Nasir, you want to tell us these employer-employee plans? There are some different elements to this. And what are the merits of it?
Yeah, so Sonia, again, I think there are lots of merits to it. I think one of the most important things is that, it gives you, the employer-employee basically gets you benefits to provide access to a comprehensive coverage, right? That may be affordable. So obviously, if you have more people being covered, the cost comes down drastically. So I think one is the biggest merit in this case is, Sonia, that because it's vast, it gives you comprehensive coverage to a large number of employees. The mortality risk or the per cover of insurance comes down. I think the other very quick one is shared premium costs. It basically, the employer sponsors typically involve cost sharing between the employer and the employee. So there's a cost sharing between both the employer and the employee in this case, and which makes premiums again far more affordable. So again, the same thing which I was saying in the beginning of the show. convenience and ease of enrollment. I think the biggest advantage, if I see so, Sonia, is it's basically very streamlined. To the entire enrollment process is very, very streamlined, making it easier for employees to select and enroll in the benefits they need. This saves employees the time and the effort of navigating the individual insurance market. So it's again a comprehensive cover. And I think the group buying power, being part of a larger group plan, employees benefit from the collective purchasing power of the organization. I think that's again a very, very important point. And the last, I think, financial security, Sonia, which also acts, as a great motivation for the employee. Employer-sponsored retirement plans such as 401k or pension plans, for example, offer employees opportunity to save for their future and receive contributions from their employer. So I think these plans also help employees build financial security and work towards their retirement goals. And therefore, it acts as a big, big incentive for employees not to leave.
Okay, got that. So I just have a couple of more minutes left before we wrap up the show. So just wanted some final comments from both of you. Nehal, for someone who perhaps has no insurance at the moment, right? No term plan, no health insurance. What are the 2 or 3 things that one needs to keep in mind before selecting and making that decision?
So like I said, that a pure term policy is a must. Whatever is your age and your annual income, if you're in your 30s, at least 20 times of your annual income is a term insurance which you should must have. You check on the cover which your company gives you for health insurance, and a super top-up added to that will be beneficial. If you're young, you can look at an ADBR, accidental benefit policy, because the chances in the younger age for mortality out of accident is much higher than any other illnesses. And critical illness cover, which is a standalone policy where in case if you're diagnosed with any critical illness, the entire sum assured is paid even if you're not hospitalized. So it's not like a reimbursement. It is a claim being paid only on diagnosis of something.
So this accidental benefits and critical insurance is a part of the term plan, right?
You can get add-ons to a term plan where you can add a critical illness cover, you can add an accidental cover, or you can also opt for standalone critical illness or accidental covers, where in case if there is a critical illness, which really doesn't require hospitalization always, but it still keeps you out of work. Like, for example, cancer, where you're getting treated at home, there's chemotherapy, and you had a critical illness cover, the entire sum assured is paid to you. So it protects you in case of loss of income while you're getting yourself treated. And it doesn't eat into the savings which you have already done. So for someone who doesn't have insurance, a pure term, a super top-up on his existing Mediclaim from the employer, accidental rider, and a critical illness. These 3-4 things, if he does, I think he's mitigated a lot of risk for the family.
Okay, and Nasir, do you want to wrap this up? I mean, what are the 2 or 3 things that one needs to keep in mind before making that decision?
But 3 top things, Sonia. It's never too late. We start now. It's always good to start early. There is something called a human life value, HLV, which I think Nehal was trying to allude to in the beginning of the show. It's called human life value. Please read up about it. It gives you basically your assessment, because product insurance is not a tangible product. It's a service. So clearly, you should know what is the amount required and start early. Number 2, I think a lot of insurance plans, we've seen this happening, and IRD has repeatedly come and said this, hiding medical information. I mean, you can't hide information if you've got blood pressure, for example, in a disclaimer and just leave it blank. I mean, you have to mention. Please ensure that there is something called a virtue of trust, and it's something between you and the employer. I mean, you and the insurance company. You have to divulge every little information about your health, about your current medical conditions, because if you don't do that, and if tomorrow, God forbid, if there's any claim, it will not be granted as per the IRD ruling. Number 3, as you start, you could be 25 or 30 years of age, Sonia. You possibly need only 50 lakhs of a term plan. Mid-30s, mid-40s, you have high liabilities. You've taken a mortgage. You've got children. You've got other responsibilities. You've got aging parents. You need to re-evaluate your life insurance plans and cover. So I think these top 3 things I would like to.
Okay, Nasir, Nehal, thank you so much for joining us on Smart Money. These are a lot of basics of insurance which people don't know about. I'm so glad we put some light on this topic. Thanks a lot for speaking to us.
Thank you so much, Sonia. Thanks, Nasir.
Thank you.
Okay, with that, it is a wrap on another edition of Smart Money. Thanks a lot for watching. Have a great weekend.